Today, I'm talking about a big risk to Apple as they report earnings this afternoon. It's May 4th. They report after the market closes. I'm going to talk about a big risk to their earnings and some risks to the stock, the price of the stock that I think people invested in Apple or that are considering investing in Apple or the market because it's such a big part of the NASDAQ, the S&P 500, the economy. Apple's a huge deal, and I want to talk about some risks with the stock. Okay, so this is Apple's page on Seeking Alpha. We can see their last quarterly earnings, and what sticks out to me here, they reported in February they missed on EPS and they missed on revenue. Okay, the stock's actually doing well this year, but first thing that pops into mind is if you think about like the history of stocks, like what makes stocks go up over time? Well, earning more revenue and improving the amount of earnings that they own over time, growing their earnings over time. How many quarters of misses can we afford to have and have a stock continue to trade higher and at the high end of its PE multiple that it's historically traded at? That's kind of question number one for Apple. So here's what's estimated or expected for the quarter that they're going to report this afternoon. GAAP EPS, analysts are expecting $1.43, which you can see is actually down quarter over quarter from $1.88. And then a revenue estimate of 92.8 billion, which is also down. Not too concerned with that because that's kind of normal due to seasonality and stuff like that. But here's the deal: EPS revisions over the last 90 days. So 18 revisions down versus 11 revisions up. Okay. So kind of the trend for revisions is down. So if they come out and they miss this quarter, they're missing this quarter after it's been revised down. And that's kind of a red flag right there, or at least a yellow flag, right? Now let's jump over to earnings estimates and get an idea of what analysts are thinking in terms of earnings expectations in the future quarters. So right now we can see this is the one we just covered for March of 2023. The quarter ended. That's this quarter that they're reporting today. Minus 6% year over growth in EPS. And then starting next quarter, and this is where it's a big deal, they're expected to get back to positive year over year growth. If Apple comes out and they don't give guidance technically, but they might talk about some things that they're seeing in the quarter, if it's a negative feel from the company, these could get revised down, which could put pressure on the stock. Now let's talk about revenue. Again, expecting a 4% drop in year over year growth, but then returning to positive year over year growth in the quarters to come. Okay, so what am I concerned with? What am I making a big deal about? You can see Apple's down about 8.87%. But if we look year to date, the stock is up 32%. Over last year, it's up 4%. It's up 261% over the last 5 years and 926% over the last 10 years, trading at a forward PE of 28, right? All right, this is what worries me about Apple. Qualcomm just reported, which is a supplier of chipsets to Apple for their mobile phones and for some of their modem and networking type stuff. Qualcomm is down 5% because they gave bad guidance on challenging mobile phone market, right? So what potentially impacts Apple a lot? The mobile phone market, right? And they specifically cited some issues with China not recovering as fast as essentially management was thinking it would. China is one of Apple's most important markets, so it could be a bad sign for Apple. The other possibility here is that Apple is just moving away from Qualcomm and starting to use their own chips or someone else, or something like that, outsourcing more of that, or just diversifying away from Qualcomm, which could be why Qualcomm saw some pain. So it could end up being a nothing burger for Apple, but I think that we are going to see some challenging demand, right? So the chief executive officer said the company was still navigating a challenging environment. They did note that they expect to significantly reduce their business with Apple through the rest of the year. And then in a statement on their third quarter forecast, management said it's continuing to see the impact of several factors on business, including macroeconomic headwinds, weaker global handset units, and channel inventory down. Qualcomm said it expects to see a larger than normal sequential decline in revenue for its QCT division, which includes most of the company's mobile phone chipsets and other mobile device products. Okay, so what does this mean for Apple? Well, again, it likely means that Apple is going to see some challenging demand dynamics. And what I want to talk about is so Qualcomm stock is down 5% today. It's a much smaller company than Apple, still a large company, $125 billion market cap. This is fast graphs, right? So don't get overwhelmed by this chart. I'm going to explain everything right here. What I want to show you with this chart of Qualcomm is the current blended PE of 11.25 is sitting below the blue line right here, which is the average PE ratio that Qualcomm has had over the last 10 years of about 16. And we also need to look at the earnings growth rate over that time because the PE ratio is often dictated by how fast earnings are growing. So earnings have grown by about 9% per year over the last 10 years. And that has earned Qualcomm a normal and average PE ratio of 16. It's currently trading at 11, and the stock is down. It shows 2%. This was yesterday, down about 5% today after reporting disappointing earnings and that disappointing guidance. What concerns me about Apple is not that I think the company's going out of business or going anywhere. We're going to go to the same period of time. We're going to go to the last 10 years. Apple's normal PE over the last 10 years is 17.6. That's this blue line. Right now, its PE is up at 28. So my only concern with Apple is that I just think the stock is overvalued. Am I going to short the stock? Heck no. Do I think if you own the stock, you should run out and sell it? I can't give you financial advice. I'm not a financial advisor, but no, not necessarily. But what I think investors need to consider is that this stock cannot justifiably keep going up when we look at it on what factors really drive stock price increases over time, and not hopes and dreams and hoping the Fed is going to lower interest rates next month or next quarter or whatever. That's not what makes stocks go higher over the long run. Stocks go higher over the long run because companies grow their sales, they grow their cash flows, they grow their earnings. That's what drives stocks higher. Stocks are rewarded for higher earnings growth and more stability in the business by having a higher PE multiple. That's the premium that Apple has because of its brand. My fear is just that this current PE is way too high, even for Apple. And if I was an investor, I would go into this thing expecting this PE ratio to get cut a little bit. And so if I want to think about, a 3-year outlook for Apple, the way I would think about that, we have the forecast here, is I think 3 years from now, the company's going to get larger and larger and earnings are going to slow down, which means there's slower earnings growth ahead. Law of large numbers, it's literally impossible to keep growing earnings as fast and revenue as fast when the numbers get as mind-boggling as what they are for Apple at a $2.6 trillion valuation, right? So I think a fair PE about 3 years from now is probably around 22.5. You would have earnings growing at about 11%. And then a 22.5 PE, you're essentially looking at a flat return from now until then. So if you get some of that correction now to this PE and the stock drops, then you could see a significant decline over the next year or 6 months or so. So if it dropped down to a 22 PE by September of this year, you'd be looking at 20% loss on your investment. If we go out to September 2024 and it drops down to a 22 PE with their earnings growth that's expected, you're looking at about an 11% loss. Now, you're going to collect some dividends, so you're going to continue to do that. And so I'm not saying, everybody's got taxes and everything like that. I'm not saying to run out and sell shares or anything like that, but it's just something to be aware of. This is my email newsletter, austin.substack.com, where I share my entire portfolio, any move I'm making, and then stock research and deep dives into more like small and mid-cap stocks that people on YouTube don't really care about. So check that out if you want to know exactly what I'm doing with my portfolio and get these reports. But I have this fear that the market is just complacent and it's kind of propped up right now, A, on the hopes and dreams that the Fed is going to lower interest rates, and then B, on Apple, I think essentially like saving the market by reporting a really strong quarter. Well, my fear is what happens if Apple doesn't, right? And so, I've got some positions that are, very risky using SQQQ. I don't recommend that for anybody, obviously. But if somebody is nervous about the market and wanting to raise some cash, but not have that cash just lose a ton of money to inflation, I am comfortable, saying that these are great options for people to consider, and obviously do your own research. But short-term bond ETFs, their yields versus cash and cash alternatives. These are almost, very, very low risk. Nothing is 100% risk free, but very, very low risk. Do your research as to why. But here's the thesis for these things. Investors interested in putting idle cash to work might consider short-term bond ETFs. After the Fed rate hikes, cash that will go unused immediately may be able to earn higher yields than at any time since 2007. Short duration bond ETFs can potentially add more income, helping you diversify where your short-term assets are held. Americans are sitting on 17.6 trillion in bank deposits, with an additional 4.8 billion in money market funds. An investment in fixed income funds is not equivalent to and involves risks not associated with an investment in cash or cash equivalents. That said, yields on savings account may not keep up with interest rate increases, certainly trail those currently available in various bond ETFs. So again, check out the website. It's on iShares.com. This is not at all an advertisement. I'm in no way being compensated for talking about this. It's just a safer way to be cautious on the market than what I'm doing with SQQQ. Anyways, T-Flow is the one that I'm really focused on and considering putting my money in, but you get a 4.99% yield for being in T-Flow, and then SHV is 4.66%, SGov is 4.35 versus a savings account at 0.35%, right? And here's a quick, just what those things are. SGov is a 0 to 3 month Treasury bond ETF, so you don't have a long duration risk there. Short Treasury bond ETF is, and it's not shorting treasuries, it's just treasury bonds with less than 12 months remaining to maturity. That's SHV. And then T-Flow is a treasury floating rate bond ETF, invests in floating rate US Treasury bonds whose interest payments adjust to reflect changes in interest rates. So every investment that you make right now needs to kind of beat the hurdle rate of these almost, very low risk options. If you can't greatly, justify better than like a 5% annual return or a 4% annual return, then it might be worth considering something like this versus, keeping everything in Apple on hopes and dreams that they're going to continue to have their same premium valuation. That's how I'm thinking about this for myself. Not a recommendation, not financial advice. But for me, every investment right now needs to essentially, I need to have a high level of confidence that it can outdo this. And in Apple right now, based off what I talked about and how premium this valuation is, I just can't get comfortable with that. And so I would rather own T-Flow right now, for example, than Apple for myself. But that's just me. Let me know in the comments what you think about this video. Do you like these videos? Do you want to see something else? What stock should I review? I want to make this channel interactive. All right. So let me know in the comments if you own Apple, how you're feeling going into earnings. I just want to hear from you. Thanks for supporting. Really appreciate it. And then like and subscribe.